Investing in crisis, stock, real estate, gold, or fiat currency, coming up live shortly. Hi, welcome to Convex Up channel. I'm Bonnie Ritzon, your host for Expert Insight at Live, a broadcast series featuring forums and interviews with industry thought leaders on market, policy, strategy, technology, and innovation that steer the industry growth. To all our viewers, if you have any inquiries or questions, kindly post them through the Q&A message box right below the live broadcast window. There are sayings that investing during times of turmoil is like trying to catch a falling knife. There has been talk of a V-shaped recovery from COVID-19's economic downturn, or it might be a U-shaped turnaround. The ultimate truth is, no one has enough information to make the logical guesses. The stock market might still go on with the yo-yo effect, dramatically swinging with even a little bit of news. So, what will be the best options to put your extra dollars? It is indeed a great pleasure today to have some of the most remarkable investment gurus to share with us their investment selections and what to be prepared with when investing in crisis. First, we have Mr. Daryl Guppy, founder of guppytraders.com. Next, Mr. Dale Gillum, executive director of Wealth Within. And last but not the very least, Mr. Joshua Robot, founder and managing partner of J. Robot & Co. Gentlemen, once again, welcome to the program. How have you all been doing?
Very well, thank you.
Great.
Fantastic.
And of course, our discussion today will be led by none other than Mr. Michael Iwitz, founder of Metallic Partners and Michael Witz Media, michaelwitzpresents.com. Michael, how are you?
I am well. Thank you very much, Barney, for a really great introduction. I also want to thank Daryl Guppy again, Dale Gillum, and Joshua Rothbard for joining today. I very much appreciate your time. And as Barney mentioned, the title of this discussion is Investing in Crisis. And I mean, I started investing in 1987, and it didn't take more than a few months for us to get to the stock market crash in Greenspan, talking about irrational exuberance. And we'll get to that later as well. That was in New York, and that was at Morgan Stanley. But before this conversation starts in earnest, I want to talk about actually which crisis we're really talking about. There's COVID-19 for sure, but do we also have a crisis of leadership, a crisis of competence? That competence, I think, is really important. And do we have a crisis in the confidence of our institutions that are out there? Or is it all of them? Is it more? What do you think, Daryl? I want to start with you, and then I want to get into some specifics about how we're going to come out of this.
I would certainly agree with you that I would tick all of those boxes. We have a crisis of COVID, it's a health crisis, and that is not the same as the global financial crisis. That's one of the most important differences that are in place. When we first moved into it, that's what the general opinion was. But in fact, this is a fiscal crisis rather than a liquidity crisis. It may turn into a liquidity crisis, but we'll see how that develops. But yes, tick all of those boxes, and that makes the markets and investing in the markets a little bit more interesting than it has been for some time.
So can you just expound on this? I mean, I want to get to the other gentleman in a second, but you mentioned that this isn't the same as the global financial crisis. I was trading back then as well, and it was very different in my mind. And I would make the case that the stock market is actually today not a really great indicator of the economic crisis that we have. And I think we could see more problems ahead of us. I'm curious what you think, and how is it different actually for people that may not be familiar with the financial markets as the rest of us are?
Well, the key contradiction is this massive difference in the behavior of what we know about the economy. We look out the window, no one's moving around, shops are closed, we can't leave the house, we've only got two people in a room, all of this sort of thing. And yet the market's living in fairyland. It's making new highs when we talk about NASDAQ, it's threatening new highs with S&P. What's really going on? And can we afford to miss out on this? They're part of the questions that we have to face as traders. But on a broader scale, we're having we're experiencing a breakdown of the institutions that we had some faith in.
We trusted them, right?
Trust. If we look particularly at the American response to COVID, there was ample warning that this was a pandemic of a serious nature, and yet we would have to say that the American response is worse than even the third world countries. The death, the mortality rate, the infection rates are out of control, and that sparks into a crisis of leadership, which leads to a broader variety of fear and apprehension, which opens up the room for attacks on China. China must be the cause of all of this. Plus, it also adds an instability to the market, not a volatility, an instability. We're in a frightening movie. We're waiting for that final frightening moment, and we'll all scream, even though we know it's coming. That's the problem we have to face.
Yeah, I mean, look, markets don't like uncertainty, and I think that's the discomfort that you're talking about. I want to go to Dale, actually, to follow up on this. So, Dale, I would agree with you when you say that, like, it's almost always at the end of market bubbles or market bull runs that retail comes in and just says, oh my God, I've missed out on all this. How can I participate? And, you know, we say smart money or dumb money, but retail money comes in at scale. And your understanding is that we're seeing a lot of retail come into the market. Do you want to go through that? And do you think this is going to continue, or do you think they're going to get carried out like they normally do at the end of these runs?
Oh, yeah, absolutely. I mean, with the retail investors, we've seen a huge influx in retail investors through right across the world, in terms of new accounts opening, participation, trading, etc. And the retail money really does come in at the end of the bubbles. And if you want to sort of study Dow theory, it's that rampant speculation side of things where the market just goes vertical. Right now, we're not in a broader market sense in rampant speculation, but segmented market we are. So there's segments of the market that are in a bubble, and we're seeing the technology sector in the US really flying. I mean, you only have to look at the top 100 stocks in the S&P 500 and the top 10 stocks, performance of the top 10 performing stocks this year in those top 100 stocks in the S&P 500 are pretty much all technology stock. They're outside of UPS, and I think there's one medical stock in there. The rest of them are all technology, all doing so well. And the retail investors are really getting into it. And if to quote some statistics, the Australian Securities and Investment Commission actually did some research between, I think it was the high in February and first or second week of April, which was basically a retail traders. I'll grab my little sheet. People can Google this. It was retail investor trading during COVID-19.
Yeah, so I want to interrupt you for a second because we actually had this conversation. I looked at this chart actually of the S&P 500 just before we did this recording. From the February highs to the third week of March, I believe, lows, it was a drop of 35% in the S&P 500. And we're almost all the way back up. I think Daryl was saying that before. We're almost all the way back up to the levels where we were just before COVID started. And so I want you to keep going, but frankly, I don't think this is sustainable just retail alone. Go ahead.
No, you're right. It's not sustainable by retail alone, because what happens is the retail end of the town, they run out of money, and that's really what's happening. So you're getting these what they're calling now Robinhood traders from that Robinhood app in the US, where within one day, I think in 4 hours, one day, 40,000 of them bought Tesla and took it through the roof. And that's what we're seeing is these broad in inverted commas, Robinhood traders who are all under 35, who are all opening accounts for the first time. They're using their credit cards to borrow as much as they can. They're getting margin loans. They're getting all sorts of money from everywhere to get into the market. But eventually they're all into the market and they're all in with all of their money. And then when there's no more money, everything starts to tip over. And that's really what happens. But in that reference period with the Australian Securities and Investment Commission survey, the amount of new account openings was up 3.4 times, and that's massive type of or increase in numbers. We saw increasing numbers of people at their time for trading. The average time for trading between buying and selling the security used to be about 4.5 days. It came down to 1 day. We saw a lot of high uptake into exchange traded products like contracts for difference and foreign exchange. We saw huge amounts of that. We saw over a period of 1 week, I think on my statistics, there was $428 million lost just in contracts for difference in 1 week during that period by retail traders. You know, if we're looking broadly across, if we look at the US, we're looking at E-Trade, they were opening up in their first quarter. They opened up, I think, 327,000 new accounts. The same in the second quarter, but they normally open about 34,000 in that same time period. So what we're seeing is this massive influx of retail investors who are pushing the market higher with no knowledge. They're gambling and they're guessing, and they've been catching those falling knives. That was sort of a part of the intro there, that we've seen a lot of them jump in those first 3 to 5 weeks off the March low, trying to get these stocks at low prices. But I would suggest most of them are struggling now, probably the last 8 weeks, with our market going sort of sideways since June, or the US market, our market, have broadly been going sideways much. They've broken out the last week, but I reckon that's where we're seeing at the moment is they've run out of money. And so I think we're going to start to see it tip over a bit.
So I've always been an advocate of sort of equal access to the market for institutional investors and individual investors. I mean, to the extent that there's now sort of a more free flow of information, we've kind of done that. The only problem is that institutional investors are so much larger. They have much more of an opportunity to understand what's happening in the market, and retail generally just gets it wrong. I want to switch instruments for a second and go to Josh. Josh, maybe you can give us a little bit of a background on gold, which has been a store of value for a time immemorial, right? About what's happened in maybe the previous 2 or 3 crises that we've seen, and maybe talk us through what you think gold is going to do now, or it's been done over the past 2 or 3 months, and how we should look at this going forward.
Right. So I'll start with the current crisis, of course, and what we've seen, gold actually was doing what it's supposed to be doing, and what it's traditionally has been doing, and that's appreciating in price when the markets are losing value. And we saw it in 2008, we saw it back in the 90s, that the stronger the market, or the downfall in the financial markets is, there's a negative correlation with gold. In good times, maybe it's just not correlated so much, but in bad times, and the worst times are getting, gold is doing very well. So we saw this year that gold is performing very, very well. I think we're up 30% this year to date, and that's after a correction we had the last couple of days. So there's a price appreciation for sure. There's a lot of demand for gold, both on the physical side, and both on the ETF side, meaning on the paper market. And we see inflows to the ETF that actually we haven't seen so far. And the ETFs are at times high in terms of how much assets under management they have. And it means that, apart from, again, think of it, gold has been a store of value, so it protects you when fiat currencies are losing money, and that's actually what's happening these days. All this quantitative easing, all this loosening monetary policy, investors are concerned with where we're heading, and we're heading into potentially either inflation or stagflation. And gold, good at protecting the value of your money, that's one. And second, again, of course, the fact that gold is a stable earner. Usually it appreciates around 10% a year in average.
Right.
And strictly also the fear factor. So when doing it, and we all mentioned how things are fragile, things are uncertainty. This is the environment where gold is flourish. Negative yield bonds, low interest rates. These were investors looking, and they don't see any other good investment out there, and they're going back to basics. I mean, I remind you, gold, as you mentioned, gold is the money before
around forever.
Money.
Yeah, it's the money before money for sure. Yeah.
So it's a no-brainer for investors when and the fear factor has strong effect. And I can tell you, we had the rally in gold actually started in 2019, and it started at the last quarter of 2019 because the stock markets were already going down, if you remember, due to trade war and other concerns on recession. So even if you look since January 2019, gold appreciated more than 50% in price. Now, this reflects on really across the board. You see from the retail client that earned, I don't know, say $500 and rushed to the store to buy some gold, but all the way up to the big central banks. So if you see what central banks were doing the last year and a half, 2019 saw the biggest purchases of gold by central banks in history. Because the central banks are concerned, because the Chinese are concerned that they're buying a lot of gold. The Russians are buying a lot of gold. Everyone are stocking their vaults to get ready for whatever is about to come. And retail investors or high net worth individuals think the same way.
Yeah, I mean, look, I would make the case that, what was it, a 32% drop in GDP growth in the United States in the last quarter. I think we have more sort of carnage to come in the economic perspective. I want to get back to Daryl on this though, right? Particularly as it comes to relations with US and China. I mean, Joshua just mentioned that China also is acquiring or storing a whole bunch of gold. But getting back to this sort of crisis of confidence, but also to the crisis of competence, I would say, and crisis of leadership, the relations between the United States and China, I mean, in my lifetime, I don't think have ever been worse. And they don't need to be this bad. We don't have to argue about the politics of it. But I'm really curious, in the context of gold and also fiat currencies, what do you think, Daryl, is going to happen to, and this is a very complicated question, right? Because oil also comes into play here. But what do you think is going to happen to the dollar as the global currency, over the next 10 to 15 years, particularly as China remains ascendant and China and the US are fighting with each other?
Okay, I'm going to answer that question by just taking a quick sidetrack for a start. I'm not too sure I agree with this dichotomy that institutional investors are smart and retail investors are dumb.
Fair enough.
And I think there are some serious flaws in both the Australian regulators' analysis of what's happening and our contempt that we hold for retail investors or retail traders and what they're doing. But we'll put that to one side and answer the question. We can come back to that one later if you like.
I want to come back to that too. I definitely want to come back to that because I have some other questions about liquidity, but also about institutions and why ETFs and the CFDs are coming in. So please remind me about that. But yeah, please, let's talk about China first.
But to answer your question for a start, which is always a polite thing to do, the most significant things that have taken place in the let's say world China space is the development of the Belt and Road Initiative, the development of a larger trade alternative to that posed by both Western Europe and by America. We have to look at the fact that the Chinese economy has essentially restructured. The level to which it relies on exports has halved since the global financial crisis. So it's no longer an export-dependent country. It's relying very much on domestic growth. But when you start talking about international trade, cross-border settlement, and so on, then the fear on the Chinese side is Trump's weaponization of the SWIFT settlement system. Yeah. SWIFT, of course, for those who don't know, is means that when you pay US dollars in Malaysia, for instance, then it goes through a correspondent bank through what's called the SWIFT settlement system. Now, what Trump has been doing is banning various banks from participating in that SWIFT settlement system in an attempt to enforce US sanctions. Iran is a good example. So Iran has sanctions imposed by the United States that aren't consistent with UN resolutions.
Right.
The United States enforces those sanctions by preventing European companies doing business with Iran because they can't settle in US dollars.
They can't pay them. Yeah, they can't pay them.
They can't go through the SWIFT settlement system. Now, of course, this has been a lurking fear at the back of the mind for the Chinese for some time. And the moves in TikTok and the moves in relation to WeChat have highlighted the validity of those particular fears, because what they're saying with WeChat is you can't do business with WeChat because we will block a bank from processing those transactions. So what are the alternatives? The alternatives are an internationalization of yuan, and that's what China was moving towards, but it's added an extra layer on that with the development of the China digital currency. And this is ready to be rolled out, and in fact, it's been rolled out across a variety of levels at this point in time. So that creates a situation where you can settle cross-border transactions in a sovereign digital currency that's not reliant upon US dollar weaponization of the SWIFT system.
Yep.
It's based on a blockchain distributed ledger. Settlement is quick and instantaneous. Rio Tinto did a major commodity deal a couple of weeks ago. What would normally take 6 to 7 weeks to settle was settled in 60 minutes. Right. With full certainty on blockchain technology. So what are we looking at? We're looking at a decline of the US dollar's role as the primary currency of settlement or stability. And we're seeing that to some extent in the drop in the US dollar, although that's more short-term rather than long-term. So the reality is that there will be alternatives and viable alternatives, reliable alternatives, and alternatives that are not politically manipulated to settling in USD.
So there was a big worry, as you know, in the 80s and 90s, and maybe even in the early 2000s, but not so much. And everybody can come in and answer this. Dale, maybe you want to jump in too, that the Japanese yen was, because it was so ascendant, was going to become the global currency. I think one of the big, not the only mitigating factor, was the fact that, one of the things that gets traded most in the world is oil, and oil is priced in US dollars, and everybody wants to settle those prices in US dollars. And that wasn't a SWIFT problem back then. We can address that in a second. But the dollar still today is the thing that oil still settles in. However, if every car company commits to going electric, fully electric by 2030, I mean, I understand petrochemicals and I understand that ships use oil too, but cars are one of the biggest consumers of oil globally. What does that sort of just like accelerate what you were just talking about, Daryl? I mean, Dale, what do you think?
Look, I agree with what Daryl's been saying about the US currency, etc. I mean, you've only got to look at how the US currency has been traveling the last couple of decades and what they've been doing. So, and I think it has been in trouble for such a long time. And I've been waiting for a digital currency to come up and a sovereign type of currency to come up. So I totally agree with it. But I think probably the other thing that I'd probably really love to hear from Daryl is about with China, obviously GDP at the moment, the US is the biggest spenders in the world, or have been for decades, but China's going to massively overtake that in the not too distant future. So I'd really love to hear Daryl's thoughts on that, and what he thinks about that. But when you're looking at oil prices, they're going to come down. I mean, obviously, as we go more to electric and be much more environmental, that's all going to happen. And, but we do need that. Globalization is here, but I think COVID-19 has really changed, had a big paradigm shift about everything, not just how we work on a daily basis, at home, or what we're doing and how we get to work and where we do our shopping, etc. But in how we do our business, not just on a micro level for a small business, but right through to, like Daryl mentioned, Rio Tinto. There's a huge shift at the moment, and we're all reorganizing ourselves. And I think the next 10 years is really exciting in that vein for me. I think there'll be new technologies come up. There'll be a whole lot of things coming up, but there is a power struggle between the US and China. China openly said they, basically want to be the dominant country in the world, and I think the US is losing its ground. And love or hate Trump, they are having a fight, and I think there's no need for it. I totally agree with it. We should all be, working together and supporting each other. But at this moment, as I said, I think the US dollar is losing its dominance. Maybe it is this. Currency that China, the cryptocurrency that China's bringing up, may become the world dominant one, and that's fantastic if that happens.
Yeah, I mean, go ahead, Josh. I want to ask you your opinion on this because you live in Hong Kong, yeah?
Yes, I want to touch on 2 points. One of them, and it shows you kind of again, one of the things I like about dealing with gold is it's kind of transcends through so many political regimes and empires that it's kind of something that's so kind of interesting to talk about. But we saw, and actually we saw lately, the reason China has been buying a lot. So China has been actually selling US dollar denominated bonds and using the funds to buy gold. So as part of decoupling from the US dollar, it started because they're looking at the US dollar as a weaponized currency. And I think we saw a very good example last year when Trump threatened Mexico to gain political, not to gain financial or trade-related goals, but to gain political goals. He threatened them by blocking them from access to the US dollar. So Russia, Turkey, you look at even Poland, so some Eastern European countries, they're looking at the weaponized current US dollar. They want to be able to trade without the need. We all agree on that. But a couple of interesting things. If you look at sanctions countries, such as Venezuela, such as Iran, actually they're using gold as a means of exchange. So I don't know if you know, but there's a big trial now in London between Venezuela and the Bank of England.
Yeah.
Because Venezuela's gold was piled in 2 vaults, one in Caracas, one in London.
Nice.
Now, the gold that was stored in Caracas actually was shipped to the Russians last year to pay the bills because Venezuela couldn't pay with any other currency. So basically, I think January 19, a cargo plane landed in Caracas had picked up the gold from Venezuela, And now they're claiming the other half, which sits with the Bank of England, and they wouldn't let them get it because of the political thing there. We also saw Iran trading with Turkey in gold because they don't have access to the US dollar. So again, it seems like we are getting on one very advanced with what you mentioned about the crypto, the national cryptocurrency. The Chinese are developing, but at the same time, we're going almost back to the Stone Age where people trade gold bars to get food.
To get food.
Michael, there are three factors that come into here that we need to consider.
Please.
The first is, from an e-commerce perspective, China is a generation ahead of where we are in Australia or where America is. That's one of the reasons they came out of COVID so quickly. They were able to, a good example, they built this hospital in Wuhan in 5 days or 10 days, whatever the case may be. Okay, that's pretty impressive by itself. But what's more impressive is that they serviced all of the occupants of that hospital using AI robots operating on a 5G transmission system. So they didn't have to staff it. So the infection rates were lower, et cetera, et cetera. So that's just a very brief example of how far ahead they are of where we are. That's number one. Number two, because they're all related, China, of course, holds massive US currency reserves, and they realised that that's a risk. And that was a risk that they realised in 2008. So since 2008, they've been steadily unwinding reserves. What you do with what you bring back. Some of it's buying gold, as Josh was pointing out. The other is that you put it into a Belt and Road initiative. You build it into a new trade environment where you can redistribute those funds within, let's call it, a more friendly environment. Now, the third part of that is that once you've got a physical logistics chain, and we all tend to focus on the infrastructure built with Belt and Road, and in fact, there are many other aspects of it, but one of those infrastructures, for instance, is that you can take a fast train from Xi'an, which is in the middle of China, to Berlin in currently 3.5 days. Now, that's interesting in itself. And one of the reasons it moves so quickly is because they're using blockchain certification for all the customs clearances. But what's more important, what's the reverse traffic? We know it goes out with goods from China to Europe. What's coming back? And what's coming back, 70% of that cargo that's coming back is commodity exports from Central Asia. That's grain, that's wheat, that's cotton, all that type of thing. Direct competitors to Australia, by the way, Dale. So this is establishing a new trading bloc that is not dependent upon the United States, that's not dependent upon Europe to any great extent, but it's enabling an enrichment, poverty alleviation, C would call it, of that Central Asian region. So we're seeing some very, very significant changes in the locus of demand.
Yeah, I mean, look, those 3 points are actually really interesting. And one, if not the most, one of the most interesting things, obviously, is this Belt and Road, which I think we all understand what that is. Right. To a certain extent, the Chinese are trying to rebuild the old Silk Road and trying to redevelop the connection between, Rome and Shanghai and Beijing. And they've been doing it very effectively. I don't think that it's any coincidence that they're using the DLT technology, distributed ledger technology, and blockchain technology to make these things much more efficient. And if you look at what the US is doing, like, you cannot ship wheat or corn or barley from the United States to Russia that fast. It's not going to happen because you can't have enough planes to do that, and it's way too expensive. And remember, because Russia's building that one belt, one road, they have free transport across it as well, right? So they don't have to argue with anybody about making that transport. I want to, maybe you could explain in a little bit more detail for people that are watching that do invest their money but don't understand what that project is and how sort of overriding it's going to be for the way trade is going to happen over the next 25 to 50, even 100 years. So maybe somebody can pick this up and explain what that one belt, one road is. And then I want to get back to this retail question because I do think it's very important, but this is also quite interesting. Who wants to jump on that one?
Okay, let's take an example. Malaysia will do as an example in this instance. So we're going to put in a fast train system that's installed by China. So that's physical infrastructure, number one. What comes with it? There's a software infrastructure that comes with it, the operating procedures and standards, the manuals, the protocols, the check-in procedures for passengers, the tracking of passengers, all of that. So there's a whole soft infrastructure that sits on top of it, and that's operated by 5G. Now, Huawei, of course, is the world leader in that environment.
Yep.
To make all that work, you have to be able to have an internationalized currency. So you open up your capital markets. So it's opening up a bond markets. It's the cross connect running between Shanghai and Hong Kong Shenzhen, between Shanghai bond markets and England. So you're opening those capital markets, but you're controlling it, as it were, controlling capital flows by using your digital currency across the top of that. So one of the key questions become, this is part of what America's on about, who sets the protocols for blockchain?
Right.
Now, blockchain's a little bit like, I don't understand it fully, it's a little bit like the old days of Apple computers and IBM computers. They don't talk to each other. It's the same solution to a problem, but the solution. How's that impact on a country like, for instance, Australia, which relies on trade? It means that if we adopt the blockchain protocols that are Chinese-based and the trade protocols that are Chinese-based, then our ships go to the front of the line. If we don't adopt those protocols, if we go with what the Americans are developing, which doesn't work anywhere except America and Australia, then our ships go to the back of the line. And this is already happening. Australia has signed a free trade agreement with Indonesia. Lots of noise about that. It's really good stuff. However, Indonesia has developed called a single window customs clearance, which means instead of having 14 or 15 different officials and bits of paperwork, all who require an extra handful of rupiah to be able to do the deal, it goes through a single desk and is done very quickly and efficiently. Australia has chosen not to be involved in the single window customs clearance. They are aware it exists, but we're not involved. So guess which ships go to the front of the line?
Yeah, the ones that have, right?
Indonesian single window. And that Indonesian single window is BRI based and will be rolled out increasingly across Asia. So it impacts not just on our trade with China, but our trade with Asia in general, plus going into Central Asia as well.
Yeah, I mean, this idea of
a threat to bring it back to what we're talking about. These become an underlying threat to markets, our competitive advantage, and where our exporters are able to work.
They do. We also talked about access to information as well, right? And if you're sitting on a blockchain that gives you information and that blockchain doesn't necessarily communicate with another one. And part of the problem is that the US over the past who knows how many years has invested less in science, less in technology. And frankly, because there's a central government in China, we can argue about, we can argue on the political side about which form of government works and doesn't work. But what you can't argue with is that the Chinese have a 25-year plan and a 50-year plan. I won't say they've executed flawlessly. But, you know, my first time in China in 1991, I remember driving around with one of my buddies who'd studied in China, and we said, like, communism's never going to work. And he said, wait a second. As we rode on the trains across China, he said, you see that? There's electricity everywhere. And you cannot do that unless you have some kind of central control. The Chinese have electrified the entire country. Let's be clear as well, and you know this too, but the Chinese have taken about 400 million people out of poverty in the last 10 years as well, and will do another 400 million people probably faster than that because of all the economic development that's taking place there. But the outgrowth of this, like you said, is the software development and the protocol development, which is going to drive other types of investments, but also lock people in the same way that the dollar was the protocol currency, right? Now the digital currency on the software side is going to change that paradigm, I think, more quickly than anybody thinks. And I'm not a shrill for any country in particular, right? I've lived out of my home country for 30 years, so I'm indifferent. But when I look at the market from a 35,000 foot perspective, the second order and the third order implications of this are strong. We already talked about the weakening of the dollar. We used to trade in crises and say it was a flight to safety. I mean, I think everybody here remembers that. You'd buy dollars, you'd buy US government bonds, and you'd buy US stocks if you wanted to have a little bit of diversity in your portfolio. I'm really concerned that a whole host of money that sits in the United States in dollars, in ETFs, in US stocks, less so in US bonds, just because interest rates have been so low for so long, so there's not much of a return there. But if that money repatriates into a place that they think is safer, that doesn't have a weaponized currency, does that have an impact on US stock levels? Because from my money, and you guys can argue with me about this if you want, right now they're not trading on economic fundamentals at any level, and I can make the case that they haven't been trading on economic fundamentals for years. But Dale, do you want to comment on that at all?
No, you're 100% right. I keep saying, especially with this whole COVID situation, there's a lot of stocks trading at higher levels for no good reason. I mean, obviously, Tesla's probably a good example of that in terms of, yes, while analysts expect that it will, some of the forecasts are saying it will be 25% of all cars sold in 20 years, I think, but that relies on them making lots of factories. But, you know, Tesla's at a price right now, it's priced or it's valued higher than Toyota, and Toyota sells so many more cars than what Tesla does. So how does that actually happen? So on that simple level, and as I said, the US market has been, at least during COVID-19, but for quite some time, I think there's been a disconnect between what's happening in the economy and obviously what the stock prices are. But I think probably one of the questions I'd actually, if I'm allowed to ask a question of one of the other
Please
experts.
do. It's a conversation,
Yeah, I'd love to ask a question of Joshua, because I know with gold, I mean, obviously that's more his expertise. And I know back in when I think it was Nixon, obviously separated gold from the currency, obviously the gold standard. The US has bought back or compulsorily acquired gold before. I think it was 2 occasions, and I know Australia's done that as well. And so obviously what we're seeing a lot of now, what I'm seeing retail clients doing, or the retail people doing, is they're buying physical gold. A lot of people are going to safety on physical gold. Is there a risk of that happening again in various countries around the world, of gold being acquired again to take it away from the retail clients?
Right, it's a good question. I don't think so. I don't think so for a few reasons. One of them, when you buy physical gold, actually it's not a financial asset. So one of the reasons people buy physical gold, it's if you know it's off their, if you like, their financial statements. So the way actually to know who's holding gold and who's not, it's pretty difficult for government to monitor this. And we see clients. Sometimes we have clients that come on board and want to buy a physical gold just for the sake of privacy. You know, kind of a value we forgot that exists. You know, being just to keep your holdings private. So I think it will be very difficult. I think today there's so much money in the financial system that if governments really want money, they can do it. We saw it in 2013 in Cyprus, when the government basically took part of clients' cash deposits to pay their debt. But definitely it's a concern. But I don't see it happening. I can tell you one thing that we see, and we saw it last year in Turkey when the Turkish lira depreciated. Actually, the government went to the public and said, "Please bring us your gold." Kind of a patriotic kind of campaign. We need to stabilize our currency. We needed to bring your gold to the central bank. So we see it. But you know the problem, like everything, when you try to impose things on people, if you can't control it, I mean, at the end of the day, financial holdings in a bank account is just digits on a server. So at any point, the government can just claim them, right? But when you come to something that's difficult to track, in the actual physical move, we see it doesn't work so well. You know, we saw in the Philippines, which is a big gold mining center. It used to be an open market, but then the government, the central bank said, okay, we're going to buy it, and we're going to buy it at almost 50% of the value in the free market of the gold. So you see the graph of declared gold going out of the mine in the Philippines. It went down 99.5%.
Right, because nobody wanted to tell the government that they had it.
And that, in a way, I would say the advantage, if you're a decent, good client, that's kind of the advantage, that actually your holdings, if they're physical, they are kept away from your financial assets.
But doesn't the follow-on question to that have to be, what do cryptocurrencies, and I'm not talking about national currencies, but sort of alternative currencies like Bitcoin and Ethereum and all these other, XRP and all these other cryptocurrencies, which again can be held anonymously. Nobody knows who owns it. Even today, we don't know. What does that do? And I know that gold, I think it was Dale who just mentioned this, but the demise of gold has been predicted since the end of the Bretton Woods system in 1971 or 1973, pick your year, whatever makes you happy. It hasn't gone away. It's had its ups and downs for sure. But what happens to gold if a country like Venezuela no longer has to beg the United Kingdom government for their gold back, because they were holding it for them in good faith, but now they can't get it back? So their wealth just kind of disappears in a poof. And that's the whole idea behind, Bitcoin from the beginning, is that you can have it and nobody knows who owns it. You can transact seamlessly. You were talking about this earlier. What does that do to gold over time?
Right. So, because I can tell you, we have a company in our group that also help clients convert crypto to gold and vice versa.
Yep.
After operating on this angle for a while, I can tell you first of all, there's some similarities between those assets in the sense that we look at both as kind of decentralized currencies that can be held confidentially. Definitely, there's similarities. But what we see is the risk profile of the clients is totally different. They look at it really from different angle. Because even today, first of all, if you look at Bitcoin, because that's the 50% of the trade is done in Bitcoin, it hasn't been proven as diversified in time of crisis. So if you looked at Bitcoin, let's say in 2019, it went down together with the stock exchange. So we don't have enough information to know whether it will be a store of value. Will it allow you to trade? Yes, but the question of the cryptocurrencies, and I think from an end user, you would like to know that someone guarantees that this thing will be honored, this commitment will be honored. Because again, it's not like gold when you take the bar. Worst case, take the bar, you go to the shop, you get money. On the crypto side, you do need to have this faith of someone to take it and give you a fair value. One of the issues we have with the crypto investors, one of their concerns, one of the reasons they move to gold is the volatility. So I agree with you. Not at the future, maybe it will be kind of an alternative. But now, if I take your example, if you're Venezuela and you want to buy, but tomorrow the holdings of your cryptocurrency will be worth half, then it doesn't really serve the idea of actually having an alternative. I think at the moment, in my opinion.
Yeah, but I would make the case that Venezuela, the value of Venezuela's gold right now is zero. Anyway, go ahead, because they can't get to it.
I'll tell you one thing. Definitely from, if you look at it, and then we get into the political kind of angle. If you look at Venezuela's Maduro's government, definitely it's worth zero. If you look at the name of the Speaker of the Parliament, which is the one that is so-called the president, it's worth something, but it doesn't have access. That's true. But interestingly, you touched here a very interesting point, because what we saw in the last few years is central banks are and by the way, private clients, they're repatriating their gold. So Germany, in the last few years, told the Federal Reserve in New York, we trust you, but we will take our gold and we'll put it in Germany. Thank you very much. We saw Poland repatriate their gold from the Bank of Finland, building new vaults in Warsaw, and they hold it there. And the same goes for China. So you did touch a point here that there is there's understanding that your gold is worth if you can control it. Not if you give someone else the key to the vault, then it may at some point be worth nothing.
Yeah, and that gets back to this idea of why cryptocurrency, I think over time, look, the volatility is going to collapse, I think, at some point. As people have more faith in it, people trust it more, and then I think gold is going to go away. But just my opinion.
The volatility is a measure of counterparty risk.
Say it again.
The volatility is a measure of counterparty risk at this point in time.
Yeah, but also it's also the holders of it are highly concentrated as well, right? So gold is all over the world, and you can trade with a bunch of different people. But the amount of consolidation in cryptocurrency is super high. It's highly concentrated.
We need more time. The cryptocurrency industry definitely need more time. By the way, also in terms of governance, I was sitting with the owner of a big exchange. It was, I think, last year, a couple of years ago. Discussing cooperation, in a very straight face, he told me, "Yeah, we had a hack last year and got $5 million stolen from us, but it's fine. We patched that security breach." Now, I was thinking, if I would sit in front of a client telling them, "Yeah, someone broke into the vault and stole $5 million," I'll be out of business by end of the day.
Right, but again, not
there yet.
Yeah, governance is obviously very important, but not to push back as well. But I mean, 100 years ago, you could go steal gold too. I want to get off of this for a second because I want to go back to Daryl on this idea of the impact of COVID-19 and in liquidity as well, both for institutional investors and for retail investors. So one of the things that makes this particular crisis very different is just the pure amount of money that the U.S. government has pumped in to the U.S. economy, whether it's through the Federal Reserve or through their purchases of treasuries, but there's a ton of liquidity there. And you were talking a little bit about, you're not 100% sure about what is it, the SIC's data on the amount of retail participation's been in the market, but there have been account openings, we know that. But that liquidity that goes into the market in the United States has nowhere to go. And I think one of the things that happened to all that liquidity, and to be fair, I don't want to get too political on this because I've already been accused of this by Joshua, but depending on where that money ends up, and if that money goes to corporations, let's be fair, what are they going to do with that money? You want to go ahead, Daryl?
Yeah, there's a couple of questions there.
Yeah.
First of all, I'm not questioning ASIC statistics. They're quite valid. What I'm questioning is the conclusion of those statistics and the
Fair
assumption that retail investors are more stupid than institutional investors. Okay, let's put that to a little bit of a test. What was the reaction of institutional investors when the market began to fall at the end of January, early February? Were they sellers? The answer is probably no. They rode it all the way down. That's what retail investors do. So they tell them. Retail investors were smart enough. We weren't.
Go ahead.
But retail investors were smart enough to jump in and to ride that rise. Now the question is, are they going to be smart enough to get out? And there is no evidence to suggest that they won't be smart enough to get out. And when they do get out, who'll be buying? The institutions will be in there buying because they've already missed, to a large extent, the significant rise that's taking place. Now, it may have been true to say 20 or 30 years ago that the average retail investor was pretty dumb and just waiting to have money taken away from him. That's being cynical. That's what fund managers are all about. Now, the retail investor is much more informed. Yes, they've timed this market pretty well. These Robin Hood traders, as you might like to call them, getting in and out in one day, that's smart thinking if you can do it, because they understand that time in the market is the primary risk in this environment. We are all saying here, all of us, that we think that the market is out of touch with the reality of the economy. Therefore, the market is likely to roll over. Now, we've got two cases. We can say, in that case, we're not going to be involved at all, and we'll wait for it to collapse again and recover before we buy. And to some extent, that's what some of the institutions are doing. Or you can say, as the traders are saying, this is a market I need caution in. Therefore, time is my primary risk. I will indulge in short-term trading only, and I'll get out at the first sign of the market beginning to roll over. And I would suspect that a large number of those retail investors who disparagingly called Robin Hood traders are thinking along those particular lines because they have more information available to them than we had 10 years ago or 15 years ago.
But can we also make the case that can we define what an institutional investor is? Are you talking about BlackRock? Are you talking about State Street? Are you talking about Vanguard and some of these Scottish widows and all these big sort of institutional investors, right? And if we are, the likelihood that they're going to be able to, even if they wanted to, day trade, if you're looking at it from a 0 to 1 perspective, is closer to 0 than it is to 1, just statistically. And the reason why is because they can't make trading decisions in a moment's notice, right? So
and that's the basis of my indicator Guppy model for moving average, which is tracking the inferred behavior of investors who are slower to make decisions and traders who are much more make decisions much more rapidly. I would describe, and very general here, an institutional investor is someone who is investing other people's money, whereas the retail trader is investing his own money. It's a very broad definition, but it captures the differences in the above. They're on opium, other people's money.
Yeah, exactly, opium. Just like other people's children.
Yeah, the key point is the assumption that the retail investor is stupid or wrong or just plain lucky or gambling. I think those assumptions are flawed. And if we're investing and trading in the market ourselves, if we make those assumptions, I think we set ourselves up to fail.
So I think that's actually the key point that you're making here, is that whether retail investors are dumb or not, if you believe that they are and actually that they're not, that's the error trade, right? But I want to get back to this idea of liquidity. Something like $2 to $3 trillion just got tossed into the market. Dale, maybe you want to comment on this as well. When that happens, that money has nowhere else to go, and that's always going to drive. And if you're a corporate stock owner and you have the ability now to buy back your stock 35% cheaper than you could buy it 2 weeks ago, you're going to do that at scale. And what is that going to do? It's going to do two things. One, it's going to drive that price up. And two, it's going to encourage retail investors to come back in the market who think they've timed it perfectly. And all the Robinhood signal traders, right? Because they're not making individual decisions. There are entire systems out there built to inform these retail traders, which didn't exist, like you said, 10 years ago, how to trade through this crisis, how to understand what's happening in COVID-19. And even if they don't understand the fundamentals, the statistical analysis trading that they're doing says you should buy now because it's down 35%, whether looking at stochastics or RSIs or whatever. Those traders don't know that, but the signals that they're getting do, and that's why they're coming in and buying. But Dale, what do you think about that liquidity infusion? And do you think it's going to happen again in the United States?
Look, what happened in the past is always going to happen again. But there's with the retail traders or those Robinhood traders, I think where a lot of the governments are coming out and saying things like our Australian Securities and Investment Commission is, it's just making it too easy for a lot of people to do their trading. So they've got their app on their phone and it comes up with a big green button, buy Tesla today, and they just hit a button and they're not actually thinking about it. So that's where they're coming. But then, as Daryl said, there's, it's probably stupid of us to think that all retail traders are not educated or dumb, because there is a lot of information. Since the iPhone came out about 11 or 12 years ago, we've had the world in the palm of our hands, and increasingly retail traders have got more and more and more information or access to it, and speed of transactions. But sometimes too much information is too much, and they are following the herd and doing things. But as a percentage, there's a percentage of traders that are very well educated and very well informed, making smart decisions, but there's also others that aren't making smart decisions. And I think it's about making sure that people are informed and doing the right thing. But when you're looking at liquidity in the market, I mean, we've constantly seen the US increase their debts. We're constantly seeing more money injected into the market. And we've seen US debt, it's just gone through the roof. I mean, obviously with the GFC, with Obama, with their stimulus package, I think debt doubled in that period of time. And obviously Trump now with the stimulus package is pumping more and more money into the US. And, that debt bubble really does continue to go faster and faster than any other time in history that I've been able to find. But if we go back to 1960, the US debt to GDP was 52.6%, and according to the US federal debt clock in 2000, it was only slightly higher at 57.13%. So it didn't move much for a long period of time, but currently it's sitting at a massive 132.57%, and because obviously what happened with Obama, and that's growing and growing every day as we're seeing Trump stimulate their economy a hell of a lot more. But if we look at that per citizen, that's about $80,000 per US citizen in debt, and for every taxpayer it's $213,000, and that's a massive amount of money. And but if you go and study modern money theory, when you're talking about fiat currencies, it's all about the country printing more money in bad times to stimulate employment, to stimulate growth, to stimulate the stock market and make everything's okay. But when good times are happening, you do the opposite. You start taking it all back. But this last decade or 20 years that we've seen, or 12 years since the GFC, we've just seen debt spiraling. So when is the good time going to come? And I think that's what people are really worried about. Mum and dad on the street are worried about too much debt. They don't necessarily understand that a nation has a different relationship with debt than an individual. If I go and borrow money, I've got an interest rate that I've got to pay. I've got a payment I've got to pay every week or every month. And there's a defined time that I have to pay that back, whereas a nation has a whole different set of circumstances. But you can understand governments pushing it. And there are a lot of economists around the world saying, that modern money theory, that, the fiat currencies is the way to go. But you've also got economists saying exactly the opposite. But again, liquidity is king, isn't it? You got liquidity, you're going to have things moving. And right now the stock market's moving nice. But I think to bring it back down to retail level, if, mum and dad level, if that's not a rude thing to say about retail people, it's really about what can I do. And I often have the people that we're talking to, on our YouTube channel or sending me emails, and they're saying all of these economic things. And I go, all you need to understand is what can you control today? What's going to happen around the world is what's going to happen around the world. We're going to have different monetary policies. We're going to have all sorts of trade things. All these things are happening, Bitcoin, et cetera, but what can you do and what can you control? Because nobody can control the markets. It's just not possible.
Nope.
But what I can do is determine whether I'm in it or whether I'm out of that market. So my buying and selling. And that's really why I say to them is, bring it down to simple terms. If you own stocks, what are you doing with them? If you don't own stocks, are you starting to buy them? And really start to understand that in simple terms and not worry hugely about the big picture, if that makes sense, and just have some simple rules around your buying and selling. And it really starts, when you start telling that to people, it starts to take a big weight off their shoulders, going, oh, I don't really need to be a highly educated economist or an accountant to understand things. You just need to understand some simple things around your portfolio, whether you hold gold or whether you don't hold gold, whether you hold physical gold or you buy gold ETFs, or whether you have physical stock, or whether you diversify, your portfolio shares between Australia and the US or Malaysia, or you buy a spread. And to me, it's always about yes, you've got to diversify, but don't too much, and make sure you've got a spread of investments, you know. But I'm not. Another thing that worries me at the moment is that I'm getting a lot of questions about is the bail-in laws that have been going around in the world. And I know Australia's got a bail-in law, and I was part with the G20 came up with after the GFC, because we had the bailout of the banks in the US, and they brought this in the bail-in laws. And I know there's a lot of retail people or a lot of worried about that, because the bail-in laws would mean if a bank's going broke, that they can use your cash deposits to basically save the banks. Now, it's not possible to do that fully in Australia at the moment. The laws are not really super clear around that. I know APRA needs to go in and take over the bank and run the bank, and if they can get it back out, they will. If they can't, then they will liquidate the bank. There's still conjecture around that, but I'd like to hear Daryl's thoughts on that, because I know he'd probably have some good thoughts on that as well.
Go for it, Daryl.
I'm not so sure I have good thoughts on that at all at the moment, though.
Well, I'd be interested in hear what you say. How's that?
I think, Dale, one of the things you've done is you've made a real distinction between trading, right, which has a much more short-term horizon, and investing. And investing in whether you're investing through any in particular crisis, if you're a long-term investor, right, and you're happy with your sector breakdown and your diversification, you used market dislocations, I think, in general terms, to buy cheaper assets that you're going to hold for the next 25 years. Again, it depends how old you are and what stage of life you're at and how much resources you have to then get into the market. But in almost no case, except going back to the Great Depression, maybe, did it take that much time for markets to recover. And everything's faster today because the information travel is much faster today. So that I completely understand, right? Daryl, did you want to comment about this as well?
Can I just finish that off a little bit for a second?
Please, please.
Just to keep it in that simple terms is when people ask me about a stock, quite often it's because they're losing money on it. They're saying, what do you think about X?
Yep.
And it really is, and nobody ever rings me worried about a stock going up on them. They just don't. That's only ever when it's starting to fall away and they're starting to lose profit or they're losing capital, they start to worry about it. So to me, it's just buy what goes up, get out of what goes down. And as long as you have an exit strategy or protecting the downside, then it doesn't matter what happens in the world. And that's what I'm saying is bring it back to some simple rules around that. If I'm into the market and I'm into a stock, what is my exit strategy? And once you've got that drawn out and you know what it is, then you take the pressure off yourself. So, you know, COVID-19 can happen, GFC can happen, whatever can happen. And Daryl said it, you know, that the retail investors got the timing right. They got out of stocks and back into stocks at the right time. And so, and they've appreciated that timing is critical. But if you're a buy and hold investor, you still do need to be a little bit more active now. You can't be like what it was 30 years where you just set and forget, put the share certificates underneath the bed and come back later on. Nowadays, you do need to be a bit more active and you do need to understand some rules around it and protect your downside all the time.
So can I just jump in for one?
Buying an individual stock is a gamble.
Yeah, for sure.
No matter what it is, it's a gamble, no matter what it is, because we can't tell what's going to happen in 12 months' time or 2 years' time or 3 years' time. A good, safe investment stock was Boeing until their planes started falling out of the sky. That was one bad hit that took off. And then suddenly the entire airline industry collapses. No one could have predicted that with COVID. When are they going to start flying again? Well, they must go out there and flap their arms up and down, because the chances of Boeing taking off again in terms of civilian aircraft is pretty low. However, if we want to look at investing for the longer term, then you go to essentially these days ETFs, where you are trading a sector. So you've eliminated individual stock risks. You're trading an underlying index. Again, you've eliminated individual stock risk. But the key advantage of an index ETF is that you have survivor bias. Now, that simply means that the index is made up only of those stocks that are successful. Those that don't match index performance are dropped on a regular basis, restructured every quarter. Only the winners are added. Geez, I mean, there is a empirical story about why the movie, the theatre industry was dominated by particular groups of people, because it was a wonderful business opportunity. People paid before they got the product. It's exactly the same with ETFs. You're paying and the product's there. You're guaranteed a return, because over time, the market will continue to rise. The index will continue to rise because It only picks the winners and gets rid of the losers and has much more discipline about it than you do. Now, we might be stretching things a little bit there, but the point sits there. If you're looking at an investment perspective, then the only safe investment is an ETF that is following the underlying index. However, you've concentrated all your risks in a single instrument, because I would suspect that the next financial crisis is going to come from the collapse of ETFs. They will become the new CDOs.
But do you want to say why? I mean, one of the reasons why the ETFs are going to collapse is because it's one of the few things that every investor invests in, and everybody's highly leveraged to them. And the idea is that if I can't beat the market by picking individual stocks, then I'm just going to close my eyes, give my money to a broker, and buy the ETF on the S&P 500 or the Russell 5000 or the Russell 2000, whatever it is. And that's why the indices keep going higher, although the stocks that aren't in the indices are just either flatlining or going down. And all this money is pouring into indices. And whether we should keep doing that in COVID-19 or not, we can argue about. But you're right, they're going to rise, because that's where all the money's going. And when people realize, wait a second, everybody's in the same trade, when people start getting out, people are going to run for the hills, and you're going to see a massive collapse. And you're right, it's just going to be just like the CDO market. There are going to be no buyers.
That's exactly right.
Anyway, we have been at this for an hour, and it's been a very active back and forth conversation, which I love. The last thing I want to ask is I want to take a question from the audience, and somebody in the listening audience asked us, what would we recommend retail investors put their money in? I don't know if we should be making investment recommendations today, but what do we think that the sectors would be? This is the question that the investors are asking over the next 6 months. And they say post-COVID, but I don't know we're going to be in post-COVID in the next 6 months, but I'll leave that up to all of you. Joshua, why don't you start, and then Dale, you can jump in, and then Darryl will end with you since we started with you.
So first of all, I agree. I don't think 6 months to see us at the post-COVID era. I think it will take. We don't even know what the financial damage is globally. We just
agreed.
And you mentioned at the beginning, the indices, they don't tell us the story. That's a very, very small angle and marginal angle of the reality. So of course, I'm not a finance guy. I can tell you from my niche, that definitely, although I don't like talking about gold in the short term, but definitely because I don't think we'll be out of COVID in 6 months, I think gold has more upside in the next 6 months. I think we're today at around the $1,940 an ounce, and I think we could go up to $2,300 to $2,400 by mid, probably in 6 months or so. So again, from my angle, I think gold has some upside in the next 6 months.
Dale, do you want to go?
Yeah, look, I agree with Joshua there. It's about, to me, with portfolio management is about spreading risk. That's really what it's about, diversification. So you do need some defensive assets like a gold. But I know more recently we've had a lot of news out there about, the millennial traders, if that's what to call them, or Robinhood traders we're talking about, saying all the tech stocks is the new go. And I remember, and Darryl remember this too, back in the tech boom bust, a lot of newspapers putting out reports saying old economy dead, new economy's there, and everything went back to all the big stocks again once the tech stocks fell to the floor. So to me, you need to have some of those tech stocks, and the tech sector is a little bit overheated at the moment. But to me, that's after COVID. There's a lot of new things happening right now. So, and as I was saying a little bit earlier, there's a whole paradigm shift. So I think the tech sector should be one that you focus on, but don't focus totally on that and disregard safety type sectors like gold or other defensive sectors like some of the big areas. I think finance or that banking sector is probably not the sector you want to be in over the coming year or two. Obviously with COVID-19, there's probably going to be a lot of defaults. I know a lot of the US banks are provisioning already for loan defaults, etc., over the coming year or two. With unemployment the way it is. So probably finance is not the area, but I would be looking more tech stocks, but looking at other industrials. What's going to take advantage of the moving forward? And we've seen, like couriers moving forward. Uber Eats is going through the roof, those sorts of things. What's those emerging areas? And that's what I'd be looking at. But again, my opinion might change in 4 months' time because COVID might go on for another 12 months. I don't know. At this point in time, we're speculating a little bit, aren't we?
Yeah, I mean, that's the fair answer, I think. Darryl, let's end with you.
I already covered part of that answer in some previous comments. So I And for the purpose of this question, I'm investing in ETFs. But which ETFs? That becomes the key question.
Yeah.
So I'm looking at S&P, not on NASDAQ. NASDAQ is a leader, S&P is a follower. So I'm investing in ETF on S&P, but I'm watching NASDAQ. And when NASDAQ starts to roll, that's when I'll get out of S&P. And I'll have hopefully 3 or 4 days warning on that because S&P is a follower rather than a leader. I'm also investing in ETFs in mainland China, not some mixture of Hong Kong and Chinese stocks. It's a very important difference in terms of how it behaves. So yes, I've got open positions sitting in S&P. I have open positions sitting in Shanghai Index on an ETF basis, being able to trade those because I'm letting someone else do the stock picking by virtue of the fact that the ETF will track what's added to those stocks. Survivor bias, I want to work in my particular favor. And then on the side, I'm having lots of fun trading individual stocks that are moving fairly rapidly. I'm fully aware that, I won't call it a fool's errand, but that these rallies are likely to end relatively quickly.
Yeah.
I'm hoping that my trading skills are enough to get in and to get out before I get destroyed on those rallies. So I'm running tight stops on a variety of situations. So I will scan to see what's moving and how it's moving. I'm not interested in what sector, that's irrelevant. What I want is a crowd. I want the liquidity. I want to be able to get into the market without moving it. And I want to be able to get out of the market without moving it. So I'm not trying to pit myself and now this is going to happen in 6 months' time, so I'm buying this. No, I'm waiting for these Robin Hood traders, for the institutional traders, for the rest of them to come in and give me the liquidity. It's like birds splashing around in a bath. You can have a great wash trade in them. So time in the market is a risk. You overcome that time in the market by trading the underlying ETFs that are going to pick up the survivor bias that's inherent in the construction of the index.
Awesome. Look, I want to thank all of you for coming in and doing this today. Let's just go through it. Dale Gillum, best-selling author, chief analyst, and the founder and executive director at Wealth Within. Daryl Guppy, it's in the name, the founder and CEO of guppytraders.com, and Joshua Rothbard, it's also in the name, the managing director at J. Rothbard and Company. This was really great, kind of exactly the way I wanted it to go. So thank you all for coming in and doing this today.
My pleasure.
Thanks for inviting us.
Splendid. Insightful discourse indeed. Fascinating stuff. Once again, thank you very much, Daryl, Dale, and Joshua for joining us today. And thank you very much as well, Michael, for presiding the session. And to all of you out there, thank you for watching Expert Insight at Live. To support our initiative in providing more industry insights and know-how transfer, please subscribe to Convex Up channel, switch on the notification, and get notified on our Expert Insight at Live on-demand videos. Follow us on our LinkedIn page, FB page, and Twitter for more interesting episodes and topics on market, policy, strategy, technology, and innovation in your economic sector that have steered the industry growth. Coming up next, are we heading into Great Depression 2.0, August 25th, 2020, 2 p.m.